And guess what, folks? We are live on Facebook right now. Not Your Average Investor Show. I'm your co-host, Pablo Gonzalez. My amazing co-host is always Greg Cohen.
Good to see you, everybody.
And today with us, we have a really I think this is going to be our best show ever, Greg. Just throwing it out there.
You know what? I was checking the weather report. Best show ever.
Yeah, because we have today somebody unlike anybody else that we've ever had. It's somebody that we have each 20 years of history and friendship with. That is a mortgage superstar with SunTrust Bank. He's a vice president over there. He's going to give us some great insights on mortgage. He is a close personal friend. He is starting to develop his voice on social media. Reminds me of a young Greg Cohen to a certain extent. And he also brings with us great bearded presence. Today is Ricci. Say hello, Rich.
I am discovering my voice. Just hit puberty.
All right, getting risque already. So if you haven't been with us before, this is pretty lighthearted. We're going to talk about some real estate investing advice. We're going to talk about mortgage and the landscape. We're going to talk about Rich's career and personal development and things like that. If you want to interact with us, we very, very much encourage it. We want you to use that chat box. Use the chat box. I suggest that you hit the drop-down menu like I was explaining earlier. Go from all panelists to all panelists and attendees so everybody can see what you're saying and you can communicate with each other. And if you want to ask us a question, we want questions. We want to have Greg answer questions, Rich answer questions. You don't want me answering questions. You want me asking them. But you use the Q&A box. Just pop that in. You put your question there. We keep track of those. That's the best place to do it because at the end of the show, we export that. So anything that isn't answered, we send it to our team. We'll get back to you either way. And finally, if this is your first time joining us, you want to know more about the basics of rental income properties and how JWB does it, go to jwbwebclass.com. It's a class that Greg put together, tons of value about what to look for in rental income investing, where to invest, how to do the filter, and the biggest pain points that you're gonna encounter so we can save you a little bit of trouble. And finally, if you are looking to get on that journey, you want some specific questions answered, go to chatwithjwb.com, pick an appointment, hop on the phone with our team. It's going to be super, super instructional. And now for some more instruction, we welcome Richard Guy Ricci to the show. And Rich, can you just give us a little bit of background on you? Just give us a little bit of your career, how you got to where you are. Just give us the intro, please.
Yes, absolutely. And I appreciate you saying this is going to be the best show ever. My goal going into this was actually to make it the second best show ever because my wife has been on the show. True. Going for number 2. So I'm firstly, along those lines, I'm husband to Whitney Ricci, which is pretty much the most important thing about me. And I have 3 just amazing kids, 7-year-old daughter, Scarlett, and 4-year-old twin boys at Andrew and Alan. And they call you Tio, Pablo. I just want to put that out there.
Tio Pablo.
That's Pablo right. Is the Tio.
Yeah.
That's how close we are. And as far as professionally, I have been with SunTrust for 14 years. I started as their subprime guy back in the day in 2006, and that only lasted about 6 months. I had to make some quick choices to change my book of business to A paper, as so they called it, and started off as the bond program first time home buyer guy, and kind of developed over the years. Currently I am more in the jumbo, space. SunTrust has a doctor loan program that I spend a lot of time. It's probably about 70% of my business is for doctors. But I am a VP producing sales manager in Jacksonville, Florida. Producing means I still have to produce my own business. So I do my own originating, but I also manage the team here in Jacksonville. For SunTrust, now Truist. So we merged with BB&T and we're now Truist, which is the 6th largest bank in the nation. So that is a little bit about me. As far as just putting a little bit of housekeeping out there for me. and I don't know that I need to do this, but these thoughts are my own. They are not truists. Okay. I do not speak for them. But I am kind of proud of what Truist has done, so far with the pandemic and everything this year. Just wanted to say that we have this program called Truist Cares, where we've given 50 million for financial relief, 100 million in payment relief, like forbearances. That's helped 60,000 families. And we did 12.6 billion, or we're on pace of PPP money. So I'll get that out there. And that's pretty much it. Anything else you want to know, dude?
I mean, there's a lot we want to know, but you don't have to say it all at once, right? Let me help you here, Rich.
Okay. All right.
So just putting it out there, everything he speaks are truths, but not necessarily truest.
Truest.
So Rich, speaking of your career, right? I know that you became the producing manager at some point last year, right?
It's been 3 years now.
Okay, I was way off.
Yeah,
But
right.
I remember having these conversations, and I also remember talking to you about how year over year you've been growing your book of business. You found like a real good niche of growth, and you've just always been on this trajectory with SunTrust. Can you give us a little bit of background into how you have approached your business growth and growing your department?
Yeah. Besides, growing through realtors and builders and referral partners, the most important thing to me is my customers, right? Like mortgages are secondary. It's delivering exceptional customer service that is the most important aspect of what I do, what my team does. It's really all about doing what's best for your clients. And if you do what's best for your clients and you approach every situation with honesty, and you own your mistakes, and you show that you really care about their well-being, you're going to create raving fans, and it's just going to exponentially grow. So that's pretty much my philosophy. I've always been ranked towards the top of customer service, all those those scores that they make you fill out.
You got some hardware for that, right?
Oh,
Like
I
you
got
a couple of
hardware, man. Yeah, I got lots of hardware. I'm at my home office though, so I only have my kids' drawings, but I like those just as much.
Those
Hey,
are
Rich,
even harder to acquire.
you were jogging my memory when you were talking about starting in 2006 with, you mentioned the bond program,
Oh yeah.
right?
Yep.
Those, that jogs my memory. It's always really nice to have somebody who knew JWB in its infancy, knew us when we didn't know exactly what we were doing or really anything about what we were doing, and we were just figuring it out. So can you kind of share with the audience what it was like in 2006? Because you helped us with some of the bond programs, which are ways for those who need down payment assistance to be able to buy homes. So very different than what JWB does now. But what was it like working with JWB back in the day when we had no clue about what we were doing?
Should I tell the origin story?
If you want to.
Okay. So Alex, one of the owners of JWB, was just going through the phone book in 2006 and calling. I think he probably called every lender in Jacksonville, and had a spreadsheet with every single thing that they did. And he just called me up and was like, "Hey man, like we're trying to refi, get some cash out. Like, what can you do?" And I was like, "I don't know, but let's do it." So I don't know if you know this, but I did your first investment property mortgages.
Nice.
Yes. So I think you had some you had a primary mortgage, and so did Adam. But
Yeah.
I think I did 3 investment property cash out refinances for each of the 3.
We're going to talk about the mortgage landscape and what opportunities are there. And then we're also going to talk about your journey with JWB, Rich, right? Like you've been a client you actually turned me on to being a client about 8 years ago.
Yeah.
And that's the reason why I know these guys. And we're going to talk about certain decisions that you've made, but let's start with the mortgage landscape. I know that right now you're busier than ever. It's impossible to get you on the phone. You've been big timing me for weeks. But what are you seeing right now in the mortgage landscape, and what people are taking advantage of?
So the mortgage landscape is it's hard to imagine how good it is right now, as far as volume is concerned, because rates are just so low. And in March, when the pandemic hit, I mean, we were all preparing ourselves for, another '08, right? Like everyone was freaking out. The housing market's going to blow up. We're going back into a recession. It's going to be terrible. And with the Fed, keeping rates low, it's, volume is, I mean, just talking about my bank, volume is like up 50%, from last year. And a lot of that is refi because of rates, but purchases are up a little bit. My business specifically last year was my best year ever. And I'm going to hit that number at the end of June. So it's unbelievable. And I'm blessed, and there are a lot of people out there that are struggling, and I hate that. But the mortgage industry and the changes that it's gone through, I think, is what's going to keep us from going back to '08. And I think that's really important for the state of our economy. For instance, like not everyone can get a loan, so you can't over borrow. You're not going to be in a situation where you can't afford, to pay your mortgage if you get into, a situation. Just some quick stats, because I know Greg likes stats, right? In 2010, so 10 years ago, 26% of all people with mortgages were underwater. So 26% of people who had a mortgage owed more than their house was worth. Fast forward to 2020, it's only 3%. So there's only 3% of people with mortgages who are underwater. 87% of homeowners with a mortgage have a loan to value under 80%. So that's a majority of folks have a ton of equity right now. 94%, have an LTV below 90. So as far as the industry and rates, it's strong. There are some issues. I mean, there are some negatives that I can go into, of how COVID has impacted the mortgage industry. But as far as rates, experts think that they'll probably stay low through 2021, which is a great thing. And as far as buying power is concerned, which I think you're very interested in, right? Like your buying power, by lowering your interest rate 1%, you can afford 30 to 40,000 more in a house. So think about that. I mean, that's like super strong. And I might be getting ahead of myself, but one of the reasons why I was hesitant to invest in more properties was, man, I kept thinking I missed the boat. I should have bought them a long time ago. I should have got in a long time ago, until rates went down. And then I'm like, okay, so what are we appreciating right now? 3%, Greg?
4.3% on average each year in Jacksonville.
Okay. So 4.3%. And if you can, rates last year were 1% higher. So they're 1% lower this year. That's the equivalent of 20%, difference. So
exactly,
you're still ahead.
And I think you brought up a really good point that perspective really will help a lot of people on the call, right? When we're talking about what caused the Great Recession, a lot of that was due to lending practices. Today, a lot of the increase in demand for mortgages and the reason why we have home sales still happening, even though COVID has affected it, is due to specifically interest rates being so low. It's not that the lending standards have become lax, right? Like Rich was just talking about how, I don't remember the exact stat, but I think it was 87% of people have an LTV of 80% or less. Was that close enough for government work there, Rich?
Perfect.
perfect. All right. LTV means loan to value. That means that they're putting 20% down. I don't know exactly what the number was back in 2006, but it was a lot lower. There were people out there that were buying houses and putting $0 down.
Right.
And that obviously creates a much riskier situation for the overall economy. So good insight on just the demand for loans, which is both refinances. So if you're an investor out there and you're looking for a way to increase your positive cash flow, you should absolutely be looking at refinancing now if you've had a loan for a while, or purchasing. Because right now, when you purchase an investment property and your interest rate is a point lower today than it was a year ago, that also means you get more positive cash flow. And that loan is there for 30 years. Like, imagine borrowing money at like 3.5%, 4% for the next 30 years. That is incredible. As investors, we can definitely do better than 4% returns. So.
Right. And anyone who's got a mortgage lately knows that guidelines are put in place to make sure you can qualify. Mm-hmm. And a lot of it is even, skewed on the other, side, where it's a little bit too difficult in some some instances, but it's definitely set up to make sure that we're not going to have another 08.
That's good to hear. And we have a question here from Ernest Gunraj that asks, how many loans can I take out? i.e., how many homes can I purchase and then buy, refinance, and how many times can I do this? Is there some kind of limit to that, or what are the limiting factors to that?
Well, different banks have different guidelines as far as how many financed properties you can have. So they're in the GSEs like Fannie Mae and Freddie Mac who do conventional financing. Once you get over 4, the guidelines change a little bit where they want, a little bit more reserves and so forth, but you can go up to 10, typically with Fannie Mae or Freddie Mac and not have a problem as long as you meet all the guidelines.
And the way I position is the best and most advantageous terms are at 10 properties or below. You go above that, you can still get it done. JWB can still help you do it. It's just not the best terms because Fannie and Freddie don't offer those products for those types of portfolio loans that you would need over 10. So keep 10 in your mind as a good guideline and know that it can be done over 10 if you need to.
Excellent. Great question. Lee's got one more question here that I think you can answer really quickly, and then we can get into your JWB story, Rich. And Lee Bishop asks, does SunTrust do non-recourse loans?
No.
Okay.
I mean, we might not, I don't. I mean, there might be somebody in the bank that does them, but I don't specifically.
Okay,
Just
great.
me.
Okay, great. We got another question from Lee fam. Lee, we're going to get to this. We want to get through a certain amount of topics before that half an hour mark hits to be considerate of everybody. And then we're going to lean heavily into the Q&A. So Rich, like we talked about, right? You were the person that introduced me to JWB about 6-7 years ago, maybe 8 years ago. I really have no concept of time. Back then, you and Whitney were doing a lot of private lending. And I know that recently you've decided to go a little bit harder at rental income properties. Can you kind of tell me your history as a client of JWB, where you're at now, and then we want to deconstruct kind of those decision-making to see if we get some value for people here.
Yeah, absolutely. So originally, I don't know, it has to be 10, 12 years ago. Whitney and I, professionally and personally have had a great relationship with JWB, but we've also done private lending. And private lending to me is a no-brainer. It's not something that you either do private lending or invest. It's like private lending is you make 10% on your money, do it. So, I mean, I've been doing that for like 12 years. And each time my mortgage gets paid off, I just roll it to another one. Now, on the investing side, I bought my first home in 2007. And when we found out the boys were coming, I had twin boys on the way. We're like, yes, so we need a bigger house. So we moved out of that house in 2014, and we turned that into a rental property. So that was my first rental. And at the time, we were like, we got one rental property. we'll just manage it ourselves, right? Like, it doesn't matter that our best friends own a management company. We don't want to pay 10%, it's
Sometimes the
easy.
people that are closest to you listen the least. It's the truth.
Right,
How
right.
much did you have Adam Riegel in your ear during that time, by the way? I want to know.
So we tried we tried managing it ourselves, and let me tell you, I will never ever do that again. And this was just one property, and it was our first tenant, and they were a nightmare. Like, we had to get lawyers involved, and it was text at 11 p.m. at night. I'm getting mad. And so after we got them out, we're like, hey guys, you take us on as a client? And luckily you did. So that was the first one. So you guys, took over that property, and then we bought a condo that's kind of outside of the scope of what you guys normally do from you, and also had that under management. And then earlier this year, I started thinking, I need to diversify a little bit more, and real estate being what I do, obviously let's look at that. So got under contract on my first property in March, right before we left to go to the UK. And then while we were in the UK, the travel ban happened. And that's another show. We'll talk about that some other day. But we finally got back to, Jacksonville, and going through that ordeal. I was like, man, I don't know. Like, is the world going to implode? Like, you don't know what was going on. So I called up Stet, shout out to Stetson. And I'm like, dude, we're friends, and I really like you, but can we put this on hold for a minute? Because I don't know, like, if the world is going to, go upside down any minute. And he was like, sure, no problem. And then you guys came out with the rent, you'll guarantee the rent for 6 months. And I learned about that from Everett, by the way. Shout out to Everett and Melissa, number one fans.
Shout out to Everett and Melissa, big fans of the show. We're happy to have you here every week.
So at that point, about, I don't know if it was a month, but it was April, and it looked like, the housing market was stable. And I'm like, okay, let's do this. Rates went down. I got a 3.5% interest rate on an investment property, which is ridiculous. Like, wow. What do you use for your ROI calculations?
We use 4.5% as an estimate for rent, even today.
Yeah, right.
We know it's going to be lower.
Yeah, so I got 3.5%. As far as the process was concerned, I was under contract, closed in 30, 45 days. And there was a tenant already in it. So as soon as I closed, I think it was like 2 days later, I got a check or an email that says your tenant has paid. And I'm like, wow, this is cool. And I mean, it's like immediately, like right after that, I was like, okay, I want to buy more, but I have no idea, like, how many should I buy? How do I figure that out? And that's kind of when I called you.
Yeah, man.
To discuss that. So I was like, Greg, I'm ready, man. I'm ready to buy more. But right. How do I figure it out? Like, how do I figure out how many to buy, and so forth? So, we kind of talked about that. And you just asked me a bunch of questions, right? Because I, even though this is what I do, like, I don't do what you do, right? So right. You just asked the questions like, am I trying to, increase my income? Is it asset driven, retirement driven? So we basically got to the point where it's not income replacement now. Like, we don't need the income now. But it is a long-term play from the point of assets. Like, I want to increase my portfolio of assets. Mm-hmm. And number two, I want it for retirement. Mm-hmm. So after our conversation, I, I went home and I started, jotting down numbers and while my family was playing in the pool and, just kind of went through, like you told me, you said, okay, figure out each different asset class that you're interested in. So I have, do you want me to kind of like go into it? I'm not going to tell you what my assets are, but the percentages and stuff.
Yeah,
How
I
deep do you
mean,
want me to go?
I think this is really helpful for folks because a lot of people first have to figure out, do they want to be in rental property investing? And then when the light comes on, then kind of like what you're talking about, it's like, oh, I see how this works. You bought your first one, that rent came in 2 days later, and you're like, dude, this is awesome. Now, how do I go bigger? How do I get to this certain goal of mine? And then for a lot of people, they don't know what that next step is, but you can easily define this. It doesn't have to be this ambiguous thing. You don't have to just say, I'm going to buy as many as I can. It's a very well thought out process. So maybe just tell people what your ultimate goal is, and then what that trigger was for you to actually decide to go and purchase the next one, which I know you just did.
Right. Yeah. So my ultimate goal was to diversify my assets and also to have income for retirement. So I went through all my assets and figured out what the percentages were and what percentage I would be comfortable to have the real estate asset class be.
Mm-hmm.
And then I figured out, when I want to retire by 55. So I went through all the mortgages that I have now, and what I'm going to do going forward is figure out how much I need to pay extra to pay it off at exactly 55, because I don't want to pay it off any sooner than that. So at exactly 55, I'm going to have no mortgages. And then I wanted my income to be just from the rentals to be 100,000 per year. And that's not including anything else. I'm just saying, okay, all else being, let's say everything else is zero. I want to make 100 grand from real estate.
Mm-hmm.
And if I paid them all off, I did the math using, pretty, 75% of rent or some conservative numbers, and came up with 8 total. So I have 4 now, and I need to buy 4 more. So, kind of looking at that, if I can get to that place, then I have no worries, right? Like I don't have any issues, retiring with that kind of cash flow. And then I am also very cognizant of, because you were the one who told me this, is to make sure that you're not top heavy, right? Like if I get to 8 properties and that's 75% of my assets, that's not good, right?
Mm-hmm.
Because if something goes wrong, I'm in trouble. So my cap is 25%. Like I'm not going to go over 25% in real estate. And if I do that and I keep enough liquid, I feel comfortable if something were to happen with, tenants and et cetera.
Absolutely. And the beautiful thing about that plan that you just talked about right there is that you talked about a really incredible goal of $100,000 a year of income coming in from those 8 properties. But you're the financing guru out there. You're going to be taking advantage of literally historically low interest rates. And that's how you can use other people's money to be able to create this amount of assets when fully paid off, but not be top heavy, because Rich is not taking, $200,000 every single time and putting that into real estate, right? If he was doing this in the stock market, he wouldn't have the ability to use leverage and use other people's money to do it. Right. So that's one of the reasons that I know, Rich, you love about real estate. I love it too. It's because I love working my way backwards from a plan, right? If I want to retire at 55, I know how much income I'm going to need at that point. And my job, especially as an investor who might be younger, or an investor who's not near retirement, right? My job is not to get that income today. It's to put the right amount of assets in there today, right? And then let that work its way down over time, right? But when you can put those assets in place today in an environment like we're seeing with interest rates so low, it's a huge opportunity, especially for those investors who have the ability to work down the payments, over the next, call it 10 years, 20 years. depending on what your horizon is. So talk to me about, when the light bulb went off for private lending versus owning properties, because I know how much you love private lending. You're earning 10% on it, but now with that same pile of money that you have right now, you're deciding to do something different. You're deciding to buy the asset instead of just doing the private lending. Why are you doing that?
Well, it's not either or, right? I'm still going to private lend.
Mm-hmm.
So I don't see it as an either or. Like I said, I'm going to do private lending regardless, because you can make money in the stock market too, and I leverage everything, I'll go for everything, but if you can make 10% guaranteed on your money, I mean, that's a no brainer. So it wasn't, it's not really, I'll say that the biggest decision that led me to start buying now is rates. I mean, 3.5% for an investment property is ridiculous. Like it's sick.
You're never going to see it again. It can't possibly get any lower. These are literally the lowest rates that have been there since they started recording interest rates back in like the 70s. Like it can't get any lower.
Yeah. I mean, the way I see it is, I mean, you have little pockets of time where you either take advantage of it or you don't, right? Like you can either be the one that does it or looks back and was like, man, I wish I would have done that. Like this could be the single, biggest opportunity in real estate that we've ever had.
Those first loans that we did with you, I think our interest rates were 7%.
They were.
And the model still worked. I still own those properties. Yeah. They're still going to be a part of my long-term.
I refinanced all of them though. Their rates are better.
With you. But when you have the opportunity to do it at 3.5%, you'd be crazy not to consider it.
Right. Absolutely.
Awesome. Super insightful. We've gone past the half an hour mark. Rich, you have a little bit more time with us today?
Yeah. For sure.
Maybe another 15 minutes. Greg, you're good for another 50 minutes.
Let's do it, brother.
I just want to tell anybody that, if you only had that half an hour time slot pegged out in your calendar, because that's what this call is scheduled for. We like to over deliver, and we do it often, by the way. We basically do it every time. So if you're just joining us, maybe you want to open up an hour. But I want to encourage anybody that's new, if they want to know more about the rental investing basics and how JWB approaches it, to go to jwbwebclass.com. And if you want to schedule a call and start talking about your particular situation, build that plan like Rich just did, go to chatwithjwb.com and hop on the phone with Stets, who Rich just referenced a little while ago. Mike Stetson, one of the sales guys. So I'm gonna do a couple user generated questions here, Rich, because I want to make the best out of the people's times that are here and helping them out. And then I want to get into a competition between you and Greg's morning routine, because I think that's going to be super valuable. But let's knock these out as quickly as we can. Lee Pham has a question. What money qualifies as reserved? Does 401k count?
Yes. They take 60% of 401k though.
Okay, so 60% of 401k counts as reserved. Anything else? Is there like a bullet list of what counts as reserved? Cash, 401k?
Bank accounts, brokerage. Brokerage, they take 70% of the value. Anything liquid is 100%. 401k, IRA. Life insurance doesn't count. But anything that's has real value for sure.
Okay, great. Eddie Harris has a question. I know that you don't do a lot of these rental income property loans, but can you discuss from the lender's side what you are looking in a potential client to lend money for a rental income property purchase? What is a lender generally looking for?
So we're looking for good credit, right? Good credit. We're looking for good income. Rule of thumb for debt to income ratio for getting a loan is usually 45%, is kind of the cap. You can do a little bit higher sometimes, but 45 is a good cap. So what that means is you take your gross income, monthly income, and you multiply that by 45%, and that's the highest your total debt load could be. So that's including all mortgages, credit cards, anything that would show up on a credit report. And then, money in the bank, of course. And then if you want to get down to the nitty gritty, being self-employed is a little bit more difficult. You got to look at tax returns. So whatever you show the IRS is what we're looking at. But the way it works is we run it through a system called Desktop Underwriter, and it pretty much tells us if you're approved or not. But those are some of the things.
Okay, great. Cecile Jamet here has a question. I don't know if it's Cecile Jamet or Cecile Jamet. Let me know, Cecile, in the text box here. But Cecile has a question. Why did you decide to have 25% of real estate? Why not 30, 40, or 50%? Is there an allocation rule guiding how much real estate you should hold?
No, I mean, Greg would probably be better one to ask this. For
Yeah.
me, it came down to what I was comfortable with. And believe me, I've Googled the crap out of all of this, like allocation, like I know all of Google at this point. and there is no allocation, no right or wrong answer, but it felt to me like it would be something that I could, looking at my other assets, I wouldn't be in trouble if I had a problem with a couple properties. I don't know. You have a better answer, Greg?
Yeah, I think it's a great question. It's the same question that Rich and I talked about when we were putting your plan together. It's, what's the right allocation percentage? It's not one size fits all. It's a combination of what your knowledge is in the different asset classes. I think that's a big part of it. It's a combination of what the potential returns are and then what the risk is. And there should be a need for some level of risk mitigation, right? Diversification is really just risk mitigation. And so really it's a function of how closely related you are to those investment classes. If you have a great, amount of knowledge and experience in one investment class, then you're probably going to be more likely to go a little bit stronger and have a higher allocation percentage in that class, right? A great example is me in real estate. As you would imagine, I'm perfectly comfortable being much higher than 25% in real estate. So this is what I live, eat, and breathe every single day for the last 15 years of my life, right? My allocation percentage of rental properties is 75%. And I'm perfectly happy with that. I sleep very well at night knowing that, because that's what I do every day. That might not be your allocation percentage, but for me, I look at that and I say, well, if I was to take some of that money and put it into the stock market, how could that lower my risk? Well, I don't think it could, because I know everything about what I do here.
Right.
And could I get better returns in the stock market? Many times, no. When you use financing appropriately, I still can get better returns by owning rental properties for the majority of the decisions in the stock market. So for me, it's perfectly okay to be a little bit higher. But I will say that I still find the need to diversify.
Right.
But I do it within real estate and within products that I know and have a lot more experience with. So I invest in private lending. I invest in syndications. I invest in owning rental properties. Obviously, our business is a part of my investment strategy as well. And those are different ways for me to diversify within real estate. So hopefully that gives you a little bit of guidance. It's not a one size fits all, but 25% of real estate holdings and rental properties might be the right answer for you, right? Maybe it's 50%, maybe it's 75%. You can talk with my team. My team will help you with that. We work with clients all day, every day, and we help them, the same process that Rich and I went through and kind of building out his plan and helping him know exactly how many he should be buying and when. We do that all day, every day for clients. So you can go to chatwithjwb.com and set up a time to speak with my team. Be happy to help you.
Awesome. Thank you. So Nuria has two questions in a row that I'm going to ask. I think one is a kind of an easy answer, but she says, I am new to JWB, credit over 760, W-2 job, 25% down. What is the best 30-year fixed rate for my purchases from JWB? My current lender is offering me 3.75 with no points. Is that good or can it get better? Sounds like it can get better, right?
Yeah, I'll take that one. I say, so the first thing is that when clients are coming, especially newer clients who are coming to potentially purchase a property with JWB, many times they're surprised to learn that you have to work with a JWB approved lender in our network. All right. So before I can tell you what we can do versus what they can do, it wouldn't be possible for you to purchase a turnkey rental property with JWB with an outside lender. And so I thought I'd kind of walk through that for just a second. Now, the lenders that are in our network have been vetted, and we know that they can do the loans that you have to get for a turnkey investment property here in Jacksonville, Florida. And they're are a lot of rules, and Rich, I'm sure, could talk about all of the overlays that banks may have. An overlay is really just an individual bank rule that may prevent you from getting the loan on your turnkey and rental property here in Jacksonville, Florida. You know, an example of one would be seasoning of the title. So some banks require that the previous owner of the property own that property for a year, maybe 2 years before you can buy it. So what that would mean is that even if you had the best credit, the best financial portfolio, you couldn't buy that property from JWB simply because we haven't owned it for longer than a year, because we're in the business of turning our assets very quickly, and it wouldn't work. And the real problem is that many times banks don't always know this. Many bank originators are not as great as Rich and not as great as the lenders that we have in our network. And sometimes they don't know these overlays, and it creates a huge customer service issue, and it creates a huge risk to both the client and to JWB. So we don't allow folks to buy without with a lender who isn't in our network, because we have to make sure that the loans close. We have to make sure that you're served as a client. So that's there for everybody to kind of know and to be comfortable with. Now, as far as rates, we absolutely want to get the lowest rate possible for you. I've heard of rates in the 3s for our clients for sure. On our property evaluations, you'll see us quote a 4.5% interest rate. That's because we try to under promise and over deliver in everything we do, especially when we're projecting returns on investment for you. So that is sort of a stagnant number that we keep. But I know that we are getting loans that are in the 3s. And so if you have specific questions, again, reach out to my team. Chatwithjwb.com is a great place to go. And then, you know, we would, of course, introduce you to a lender in our network. We would be able to get you a better insight into exactly what your interest rates would be. But it does seem very comparable based on what you were sharing with us as far as what the rates that we could get for you.
Yeah, and then Nuria also asks, she's on her 9th. What would she do after after 10?
You know, there's specific portfolio loan products out there. So what Rich was talking about as far as getting up to that 10 level, those are your Fannie Mae and Freddie Mac backed products. They don't allow you more than 10, but individual banks may keep their own loans or have other back-end investors who are comfortable lending to you. If you have more than 10 financed properties on your credit, the terms just aren't going to be anywhere close to, 4% interest. It's going to be a higher interest rate because they're taking on more risk, and they're a much smaller, you have much less options there. But you still can get positive cash flow, or it might be very close to break even because your interest rate might be, 7% to do it there. So that's why we go with the Fannie and Freddie products to get you anywhere close to 4.5% or lower for your first 10. But that doesn't mean you have to stop at 10. You work with us. We build out this plan. We've got this plan many years in advance for you many times, so we know exactly where you're going to go as you meet that threshold of 10. Did I miss anything there, Rich?
Nope, you got it.
Cool.
So we got a bunch of questions. I know that we're trying to wrap up, Greg, because you got something coming up to go to. I want to encourage everybody. There's a lot of really specific questions here, and a couple of questions that we answer a lot on the show, right? So Pat Staub, you got a couple of these. Bill Shields, Ernest. You got 5 more minutes.
Yeah.
Okay.
Let's try to pick maybe the 1 or 2 that maybe we don't answer. And JWB Web Class is a place I know answers a lot of questions as well. That's that training I put together. So for any of those questions we can't answer, I would recommend go to jwbwebclass.com.
And I really want to encourage all of you that are here that are asking these common questions, go to jwbfacebookgroup.com and sign up for a Facebook group. We have over 1,400 people inside the Facebook group. Greg's in there every single day. That's a really good place to get your questions answered. And then again, also chatwithjwb.com, set up an appointment, and you'll really get some specific answers to what you got going on. So, all right, let's try to pick out the one that has the most value here. Which would be better for cash flow, buying 1 house with cash or buying 4 houses with loans?
Well, a lot would go into that, assuming we have to make assumptions based on interest rates and your potential cash flow. What I'll kind of share in generalities with you. When you buy with financing in place, your cash flows are going to be lower on an individual basis. But what you're doing is you're putting, let's say, 4 assets into your portfolio versus one asset. So when you're deciding between cash purchases and finance purchases, your cash flow at the end of the day will be very similar. The take-home cash flow between 4 finance properties versus one that is owned free and clear, your net cash flow will be pretty similar. But the play there is that you have 4 assets in your portfolio, and like Rich is talking about, getting more assets in your portfolio and letting the debt pay down happen over time while your properties are appreciating at roughly 4.3% in the Jacksonville market will leave you 10 years or 20 years down the road with much more net worth and wealth. So that's typically why you would go to financing, not so much that you're going to get more positive cash flow than a cash purchase.
Okay, and here's a good one that I think Rich can answer from his perspective, and maybe Greg, you can piggyback as well. Matthew Pernat asks, under what circumstances, e.g., environmental, personal goals, etc., would I choose private lending over buying turnkey? Rich, maybe you can answer that on a personal level, and then we can put some scope on it.
I think if you're looking at either or, I guess it depends on what the the barrier of entry is, right? Like I don't know what your minimums are for private lending, but that could you don't have the money to put down on buying a house, so you want to do private lending.
Mm-hmm.
Also maybe a little less risk in private lending, right?
Mm-hmm. Mm-hmm.
Those would be my 2.
Yeah, I'll kind of break it down. I just actually had the same conversation with a family member of mine over the weekend. And so I'll tell you about my conversation there. But generally speaking, you should earn better rates of return by owning the assets. If you're using financing when you're purchasing them, you should earn better rates of return when you own the asset, when you buy the turnkey rental property versus private lending. All right. And the reason is because in private lending, you earn a straight 10% cash on cash return, right? What you don't get is you don't have to worry about maintenance cost or vacancy cost, right? It is just set it and forget it. JWB pays you every single year and you earn 10% on that. But what you don't get is you don't get the increase in the asset value. Another word for that is home price appreciation. You lose out on the growth. So when you own the asset, especially if you use financing and you hold on for the long haul, which means you can count on home price appreciation, that's a lot that you're giving up, right? Because if your asset goes up 4% a year and you only put 25% down, that's a 16% return on your money, right? So by owning the asset, that's 16% there, plus you'd earn 7 to 9% based on the cash flows as well. So the true comparison for private lending versus owning the asset might be somewhere in the 20s when you're counting all the profit centers for owning the asset versus 10% for private lending. Now, why might somebody choose private lending knowing they could earn more? Well, I'll tell you about my family member conversation. This is a family member who is getting close to retirement, and they own 4 properties with us already. And they said, Greg, I was in the group on Friday. I saw you do your walk and talk where I highlighted one of our cash flowing rental properties. And they said, should I buy this one? And I said, well, let's sit down and talk about this. Tell me about your plans. Tell me about how important it is for you to retire. When is retirement happening? At retirement, what's more important for you? Is it maximum cash flow and removing debt because that helps you all sleep better at night? Or is it earning the best rate of return for you? And she said, it is definitely about maximum cash flow and removing the debt, because she shared with me that, if something should happen to her husband, she wanted to make sure, and her husband wanted to make sure that they didn't have any hassles when it came to monthly income. They didn't have to dispose of the assets. They didn't have to think about it, even though they know me, right? It would keep them up at night. And so safety and security in that family construct is really important to them. And, if something should happen, they wanted consistency more than anything. They wanted maximum cash flow, and they're willing to give up that additional positive return on investment because they already own 4 houses with us, right? They've already kind of checked that box off. And so we said, let's not buy that one. We said, private lending is better for you, right? It is set it and forget it. If something should happen within the family, something negative should happen, or when retirement happens, they're going to want to make sure they get rid of their debt at that point. And so for them, private lending is a great option. So I actually advise them not to purchase that house, to go to private lending specifically in that situation.
Excellent. Excellent. All right. Everybody that has put in questions, Bill Shields, Ernest Grunraj, Leo, Pat Staub, I have everything copied and pasted here. I'm going to send it to our team. We're going to reach out to you with some of the answers and the keys to what you need. But I encourage everybody, join the Facebook group, go to chatwithjwb.com for some of these specific questions, or at least go to the web class, jwbwebclass.com. Rich, I want to ask you one final question because I know you're dying to get this off your chest. Tell us about your morning routine.
Oh, God.
I want to hear about this. I don't even know this yet.
I don't know if Whitney wants me to share because everyone will think we're crazy. What time did you wake up today, Greg? I woke up at 4.
You beat me.
Yeah.
I woke up at 5.
Figured. Lazy. You're lazy. Do you really want me to tell the morning routine?
Yeah, man. Tell us how you learned it and tell us the benefits you're getting out of it, man.
Okay. So the morning routine is lots of benefits from the morning routine. One is, forming positive habits that are, that bleed into, everything that you do. You get some time without your kids. That's huge. You're more productive. And some people will say, I'm not a morning person. That's why I don't wake up early. I never used to be a morning person either. Like I just started doing this last November. And if you say you're not a morning person, like I told Marta, that's a limiting belief, right? You can be a morning person if you want. And some people will say, well, I stay up late. Well, you're not getting things done when you're staying up late. You're watching Netflix or Tiger King or something stupid like that. You know what I'm saying? And I'm not watching Tiger King. So wake up, right? Go to the kitchen, drink some celery juice on an empty stomach, mix up my energy drink, go upstairs to my man loft, also called the Zen Den. And
I like that. It's very, very nice. The man loft. Usually it's called the man cave. It's the man loft. Huh?
Yes. So then I sit down, I meditate for 10 minutes. Meditate or quiet time. After I meditate, I journal. And I have a very specific way that I journal, and I'm not going to get into the details there. Right after I journal, I read a daily affirmation, and then I go through my affirmations that I've written down for myself. All positive stuff flowing up here, and then right after the journaling, I jump on my work stuff. So depending upon how much I need to get done, that will determine how much time I spend on the work stuff. But I will take out my work journal, which is a different journal, this one.
Nice.
And then that I'll plan my day and plan everything, all my goals and stuff for the work day. And then that's usually about 6:45, 7 o'clock. At that point, my 7-year-old daughter comes upstairs. She knocks on the door. I let her in. We watch. I'm taking this class online with Coursera at Yale University. I go to Yale. The Science of Well-Being, and me and Scarlett do about 20 minutes of that class. And then we go downstairs. I set up the cereal for the kids. Scarlett and I, and sometimes the boys, we go outside, take my dog out. My dog and I go pee. And the family hugs the tree. We hug a tree. We say a prayer.
I've seen this.
Yes.
This is incredible.
We say a prayer. We run around the lake. We sit on the bench. I take 10 deep breaths, and I think about all the people I love, and I think about what I'm grateful for. And then we run back, and then I go work out. I do abs, I stretch, and then I do cardio. And then right after I do cardio, I go and I put on a song called Hot Shower by Chance the Rapper, and I take a freezing cold shower. And right after the shower, I get to work, and that's it.
So 3 hours.
What's your routine, Greg?
You know, man, I'm in awe. I don't know what to say. I mean, there's so many questions that I have based on so many specific things you do there, from the celery juice to the cold shower. I mean, I feel like everything is very intentional.
It is. Everything that Whitney and I do is intentional. So we are intentionally creating the life that we want, and we do it every day, and we do it consistently, and our kids see it, and our kids, I mean, it's amazing. Like it's just, it's yeah. I do lift my leg. Yes. Actually, my dog doesn't lift his leg, but that's another story.
I think it's really awesome. So you're doing this with Whitney, and you're doing this with your kids.
So Whitney does a separate routine at the same time, but we're in different spots. Incredible,
man.
Yep.
It seems like it's half the benefit of everything that it does for you, but half the benefit is for your kids to be able to see what it means to lead an intentional life, huh?
Absolutely.
That's awesome, brother. Well, I'm not even going to tell you about mine. It's going to play second fiddle to yours. A lot of the same elements there, but I have something to aspire to, brother. I like it.
Thanks, Rich. Hey, Rich, thanks for sharing that with us. I know Greg and I have been talking about it. We wanted to hear that whole routine. So thanks for letting us in on that secret. Thanks for joining us, man. I thought this was really valuable for people to hear the customer journey, the decisions that you've made, not to mention the mortgage advice that you've given. Is there anybody that wants to get a hold of you? Is there any best place to get a hold of you?
Website, suntrust.com/Richard.Ricci. Facebook, you know.
How do people get to find out and watch your videos, by the way, on Facebook? They have to be your friend on Facebook? Because you got to create a page or something, because people need to see you.
Yeah. Okay. Yeah. I could create a YouTube channel.
No,
just for you, Greg.
The world needs it.
Listen, Rich is part of our Facebook group. So if you connect with us on Facebook group, jwbfacebookgroup.com, you can find Rich in there. You can make friends with him online. He is open to online friends. We all know this because he's now making all these quarantine advice videos, super, super valuable. And as you can imagine, full of beard and humor. So thanks for joining us, Rich. Really appreciate it. I really want to thank everybody that joined us. Again, we went an hour. Sorry, Greg. I know we were trying to make it a little bit shorter this time, but I thought there was a ton of value, a lot of good questions. Again, Ernest, Bill, Leo, and sorry, guys, Pat. We're going to follow up with you guys. Look for an email.
Can I say one thing? Can I say one thing?
Yeah,
and this, do something to make the world positive. Right? Start with Facebook. Stop arguing with people on Facebook. If someone tries to argue with you, reply that you love them and you don't want to have this conversation right now. Start being positive. Be the solution, not the problem. That's all I got.
Love that.
That's excellent. We usually give Greg the last word here, Rich, but that was really well said.
That wasn't the last word.
That was it. That's a wrap. Rich, love you, buddy. Thank you for being on the show.
Love you guys.
Thanks for being on. Hey, everybody, go to jwbwebclass.com for some info. Go to chatwithjwb.com, set up an appointment, get your questions answered. Everybody whose name I called out, I got your questions. We're going to reach out. Thank you, everybody, for joining us. See you on Thursday for an all Q&A so that we don't have to, interrupt your questions. We can just go straight to Greg with all the questions. Have a great day, everybody.
See you guys.
Take care.